it's different. And I'm very careful with my words saying you're going to be subject to this tax, because it doesn't mean that you're necessarily going to have to pay that tax.
And you're known as the cost segregation king in the real estate world. For those of us who might not be too familiar with the term, can you explain what cost segregation is and why it's such a powerful tool for real estate investors?
Yeah, it's a really powerful tool, and it's a really weird name for this tax deduction. Okay. Essentially, what it is an advanced form of depreciation. So, depreciation is a income tax write off, a deduction that you get anytime you buy a property. So, besides for your primary residence, any type of property, whether it's investment or business property, is eligible to take this write off, essentially saying you can write off the entire value of your property over a certain number of years. So residential properties, it's over a 27.5 year period. For commercial properties, it's over a 39-year period. So these arbitrary numbers, but essentially says you can literally take a little deduction every single year and write off the value as if it were going down in value. So important to note, depreciation from a tax perspective is just a borrowed term. It doesn't actually mean that your property is going down in value. It just means the IRS is going to give you this tax deduction as if it were going down in value. So that in of itself is huge. And we talk about real estate investing and the tax benefits that come along with it. Well, depreciation is the biggest one. And cost segregation then takes depreciation to a whole new level. Okay, so let's just break down what the word means, right? The phrase cost is the cost, the value of your property. Buy a property for $1 million. That's the cost. Okay. Segregation, we're segregating or we're breaking down the property into different categories. So certain things, right, like the structure of the property, that's what really has that long depreciation of 27.5 years. And it's based on when the property was purchased or placed in service and not when it was built. So again, this is it's a borrowed term because it's based on you, the taxpayer. When you buy a property, you get to start this whole clock, this whole schedule over brand new. And cost segregation breaks it down from structural to things that are non-structural, like personal property, things like furniture, fixtures, appliances, window treatments, carpeting, flooring, cabinets, countertops. All that stuff that's inside your property that's non-structural depreciates on a 5-year schedule, which means we can now take the value of those deductions over that 5-year period at a faster rate. And this can be extremely significant, which ultimately leads to bigger deductions during the early years of ownership. And that creates more cash flow as an investor that you can, instead of paying taxes, use to reinvest. And so that's why you ask, why is this such a powerful tax tool or strategy? It's for that very reason. This is a tool to create cash flow for someone who's an investor who wants to lower their tax burden and use their own money to reinvest and buy more.
I'm curious, how does this affect the event of selling an asset? Let's say that you're using this tool throughout the time that you're owning a property, and at some point you're selling. How does that affect that event when you're selling? I guess there's different approach on depreciation.
Absolutely. So anytime you sell a property, you are going to be subject to a tax called depreciation recapture tax. Okay. And it's similar to capital gain, which everyone understands that if you sold a property at a profit, you're going to be taxed on that difference between the purchase price and the sale price. That's called capital gain tax. Depreciation recapture is an unrealized gain, meaning it's similar. You've taken these deductions during the years of ownership and now are going to be taxed on however much of those deductions were taken. So it is something you have to be aware of. It's definitely, like I said, a strategy that helps you during the years of ownership, creating more losses or more deductions. But then on the sale, you're going to be subject to this tax, which it's different. And I'm very careful with my words saying you're going to be subject to this tax, because it doesn't mean that you're necessarily going to have to pay that tax. Okay. Legally, there are many ways to either defer or eliminate or, offset those taxes. And so it is important to understand the rules behind investing and the rules behind, tax savings and how to use depreciation properly.